Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic. Starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlotnik. Today it is my pleasure and a privilege to welcome back Jeremy Roll. Hi, Jeremy.
Hey, Mike. How you doing? Thanks for having me back. I appreciate it.
Thank you kindly. You're a three-time guest now. You've entered the.
Wow, I thought it was the second time. I'm losing track, so sorry.
I think you came twice within a very short amount of time, and then
Yes.
This is the third time. It's been a while since we did the first two episodes.
Yes.
So thank you so much for coming back. How's sunny California doing? How's your neck of the woods?
I'm looking outside. It's sunny. It's the usual California weather. You know, we're recording this in March, and it's almost like the same thing every day. So I used to, I grew up in Montreal, so I've been through the tough weather and very cold and snowy weather. So just so people don't think I was here my whole life. So I've been through the tough part, but this is the easy part now with the weather.
Yeah, nothing to complain about. That's why it's called sunny California. The weather is certainly beautiful.
Yeah.
All right, so let's jump straight into some of the geopolitical events that are happening in the world and how it's impacting U.S. economy. So the war in Ukraine, the invasion, the Putin's war, is obviously hurting a lot of people. A lot of people are dying. A lot of people are injured. It's a massive humanitarian crisis. I grew up in Republic of Moldova, which was part of the Soviet Union on the border with Ukraine. My wife is from Ukraine. A lot of folks that I know are from Ukraine. So Ukraine is certainly dear to my heart, and their pain is my pain. So I'm certainly very, very upset about the whole situation. I wish this war will come to some kind of resolution. I don't know what it'll take for this war to come to a rapid end, but any quick thoughts on this? And then we're going to go to the main question. What is this war doing for to the U.S. economy? What is it doing to the global economy? What are your thoughts on this painful subject?
Yeah, I mean, I'm very sorry, obviously, for your wife and family and everything else. There's a lot of bad things going on, obviously, overseas. My understanding, or my best guess on it anyway, based on everything I've read quite a lot about it, is that hopefully the war won't extend too far in terms of many cities and everything else. That would be a best case scenario. And frankly, hopefully it'll just come to an end sooner or later. So I just hope there are obviously the least amount of injuries and deaths possible from here on in. That's the most we can hope for, I think,
That's right. But what do you think about the economic impacts? Obviously, the end of war, it'd be great if there was a resolution, but I want to spend a lot of time. I strongly believe that unfortunately Putin has become very close to what Stalin used to be, and it's very difficult for him to walk away without declaring some kind of a victory, even if it's not a victory. Nonetheless, the Russian economy has been completely in shambles, and the whole thing has been turned off. So the energy markets are greatly impacted, obviously, and now you can't say it's only the Russian invasion is causing the oil price going through the roof, but it's certainly having some impact. So just from your understanding, again, you have a great economic mind. What are your thoughts, just energy, anything else? What's the impact on the U.S. Economically?
Yeah, so great question. So I think that there's a number of impacts. I do want to point people to the fact that prior to the war, oil was already very high in the U.S. It was, the U.S. Oil was, the WTI was in the $80 to $90 range. So we're obviously higher than we were, but, it was already starting from a high place for other reasons. And I think that it's interesting because there's a lot of important roles that Russia plays as far as supplying energy and food in the world. A lot of people don't realize, and I hope I have my numbers right, they may be off by a little bit, but for example, I believe that Russia oil supplies about 10% of the world's oil. They supply an unbelievable amount of gas, natural gas, to various cities in Europe and other countries as well. They provide, I think, if I have it right, about 25% of the world's wheat, which, if you can imagine how wheat is in everything. and or I shouldn't say in everything, but in many things, and a very high percentage of the world's corn as well. And these are basic, important staples. And of course, with some of the measures that the U.S. have proactively taken from an economic perspective, I don't think that in the U.S. we can think to see any of these commodities being imported into the U.S. anytime soon beyond, I think there's like a 45-day window for some of them. So I do think that that's going to cause some potential challenges for us here. I do think it has definitely impacted inflation and will continue to impact inflation. And the thing is, I don't think it's a question of the war just coming to an end. I can't imagine that, President Biden is going to reverse these bans, right, all of a sudden. Maybe I'm wrong. Maybe be part of a settlement. Maybe it actually helped to get everything to a final, conclusion sooner rather than later. But I do think it will have a long-term impact. Now, interestingly, the U.S. consumption of oil is only 3% Russian oil. So, but what's killing me, and I don't even vote because I'm just fed up with politicians on all sides, right? But what's killing me is that we have the potential to increase production in the U.S. and we're not. And I understand it's for environmental purposes, but what's killing me is that the reality now is with inflation where it is and going up. I was telling my wife, there are people who have to choose between driving to work and eating lunch, and that's not just like a line, it's a fact. So it's killing me a little that the U.S. isn't taking a stance on increasing the production of oil to at least help with supply, because it's a big supply problem at the moment. But that's a different story. I do think that what's happened from a Federal Reserve perspective is it's basically, we're recording this in March, and we have the lucky timing that the Federal Reserve had its meeting yesterday and announced that it was doing its first 25 basis point increase. But what's interesting about what they announced is that I think that wasn't a surprise, obviously, but what was surprising to me is that I think traders expected a 4 to 5 increase, 4 to 5 25 basis point increases over the year. The Fed specifically very clearly said that they're planning on 7 increases total, including the one they did yesterday, so another 6. And that was surprising. And I think they're kind of starting to feel like they have no choice but to deal with inflation, even at the the detriment of the economy. And I want to put one more thing in people's minds, which is, as you're thinking about this whole scenario, I personally am a very strong believer that the government and the Fed realize that they can't let inflation go on for a couple of years compounded, because, as we all probably would agree that like prices won't come down later, right? Your box of cereal probably isn't going to go down $1 at some point. It's going to maybe go flat for a while, right? Your rent isn't expected to decrease 20% once inflation subsides, right? It's just not realistic. And there's going to get to a point where it'll have a very long-term and detrimental impact on society. And we can get into that too, but some people believe that's going to happen, and some people believe the answer to it is going to be universal basic income, right? So there's all different angles you could take on it, a lot going on, a lot changing all the time. And one more thing I just want to throw in is I'm watching the yield curve very, very closely. I've been watching it as a signal of a potential recession coming up. It's my number one indicator. And, the 5 and the 10-year yield curve inverted after the announcement. It's currently not inverted today, but only by 1 basis point. The 7 and 10-year, I think, has been inverted for a while. The 2 and the 10-year now, as of right now, before we got on, is maybe 26 basis point spread. So very close to inverting and been heading in that direction. So all indicators are pointing to a high probability of a recession coming up. And what's interesting is that a recession typically occurs from 3 different factors, okay? Inflation, increasing interest rates, or a dramatic increase in commodities, especially oil. We actually have all 3 at the same time, which is actually unusual. And so to me, the probability of recession, it's not 100% clearly, but it's very high at the moment in the next 6 to 18 months, I would say.
Wow, that was a lot. You just compacted a lot of great nuggets here. So I'll provide some quick commentary. And so I certainly follow the yield curve, and everything you said on the projected Fed rate increases and the yield curve inverting, certainly on my mind. I literally wrote last night a few sort of mini thoughts, and it's coming out as a newsletter next week. But it's almost identical to yours. That the yield curve needs to invert before we have a high confidence of the recession. And it does typically, recession follows anywhere from, I think, 1 year to 2 years after the yield curve inverts. And I think that's the 2 to 10 inversion. So if we see that, then the probability of some level of recession is likely, especially with Fed moving the lever, the interest rate lever so fast. It's not just the rate increases, it's the speed of increase in their relative from a very low base points
Yes.
to the relative impact. It's not like 5 or 10% increase. In some
Yes.
cases, it's going to be 20, 30, 40, 50% increase on the debt service for
Yes.
some of these low yielding bonds. So from that perspective, that's critical. So let's go back. One more quick commentary on Russia and Ukraine. Well, Ukraine is one of the largest wheat producers. So I wanted to add that comment too. So the war in Ukraine is obviously taking massive amount of wheat out of circulation and obviously causing further inflation. So it's the same point you said, both Russia and Ukraine, the production of wheat will come down and the food and energy prices here are obviously greatly impacted. But let's go back quickly to the Fed action. So they obviously took a more measured step. The general consensus pre-meeting that the Fed was going to raise rates about 50 basis points. That was at least my understanding, that there was a more likely scenario. Maybe the war in Ukraine basically gave him a pause, turned him into a little bit more hawkish opinion. And the stock market reacted pretty positively to more hawkish Fed, even though they announced likely every meeting they're going to do some kind of an increase, and they have 7 meetings coming. So what do you think, and who's impacted? Who is the most impacted by these rate increases? What kind of businesses? My sort of a view is the McDonald's of the world with high inflation actually benefit because they can raise prices. Some of these biotech companies and other technology companies that don't have a big install base, the cost of money goes up a lot. And then if they have over leveraged balance sheets, it's a lot of pain. What are your thoughts?
Yeah, it's a great question. It's very complicated, because I was actually just reading an article yesterday about Wendy's, and because of the inflation on the wholesale side for them, all their costs, they're going to be increasing the prices of kind of a la carte items, for example, but keeping their $4 menu, whatever the 4 for $4 menu, or whatever it is, right? Because they're scared. They're scared to raise prices and to potentially lose sales, and that they're scared that the consumers are not going to just absorb all the price increases. So they're going to do on the stuff that maybe isn't as popular. They think they can kind of push the needle, but they're afraid to change their current promotions, and that's obviously going to impact profitability. So from a stock market perspective, if the companies can't pass it along or don't want to pass all of it along, their profits are going to obviously decrease, and that's a challenge for the stock market and earnings, right? I would say that. God, there's so many different angles you can look at this. Some businesses will be able to pass it along easily. Some won't. It's funny. I read another article today about Rivian, which is an electric car maker, right? And they just came out with their first vehicle. It's a pickup truck, and they're privately owned. Jeff Bezos is a big investor in them, and they literally just increased. Like, you had pre-orders for a year or two, okay? They just increased the base price of both of their vehicles by 17 and 20% respectively. Prior to then, they just launched deliveries a couple weeks ago, but before they did it, they have to raise prices. And there's been a backlash online because somebody that ordered a car with a base price of 70,000 is now being asked to pay 84. And what they're actually doing is saying, okay, well, you were going to have this and this an option. We can keep you in a similar price range, which is a worse model. That's kind of their solution, is you can pay the same price, but you get the worst model, right? And someone's been waiting a year or two for this model. And so really, each company is going to be impacted differently as to whether they can really pass the true cost along. What I'm really concerned about, Mike, is the fact that I just don't believe that the inflation numbers that the government produces are real and that they've been adjusted over time. They were actually adjusted in January once again, the basket of goods, to help them look lower than it really is. And if you look at the pre-1982 calculation, which is when they really got a hold on it to bring inflation down, we're at 15% right now. And what I'm really concerned about as an investor is, how do I keep up with that 15% after-tax return? And are my investments going to be able to pass along 15% rent increases or 15% increases in revenue, whatever it is that I'm investing in, right? And I think that's a big challenge that I'm not necessarily relying on. So, it's not just consumers that are probably going to fall behind, it's investors. And I want to just point one other piece of data out that's very important. I don't know if everybody knows this, but for the past 11 months now, the average median income, sorry, the median household income in wage inflation adjusted is actually negative. The actual median household income is not keeping up with inflation increases, but that's actually based off of the inflation that's published. The real inflation is worse, most likely. So consumers are already falling behind. We're talking about for a year now, right? And now inflation just starting to pick up worse. And so this is a big problem. My personal hope is that hopefully the Fed will increase quicker than not, because I think it could have a big impact on society. And going back to real estate, I think that it's going to have an impact on asset prices. If you look at home mortgages, which is an easy metric to follow because they react very quickly, home mortgages are up 100 basis points in just 3 months from the beginning of the year. And the Fed actually, as part of what they announced yesterday, is that their total expected interest rate increase compared to prior expectations is now 25 to 50 basis points total higher down a couple of years, not just for this year, the total. So I expect mortgage rates to head up further, another probably 50 basis points, give or take 25 basis points, because a lot of this is already built in. It's already built, like, the expectation is already built into the increase. But and I think that obviously on the real estate side and the business side, all these interest rate increases are going to make a big difference. And Mike, I think you made it an extremely important point. People talk about 25 basis points. It doesn't sound like a lot, but when you're starting from a very small number, the percentage increase is really what you have to look at for the debt service. And so don't get caught up in the fact that you're like, oh, they're only raising it 50 basis points, 75. No, you got to look at what it's at today and how much it's going up percentage wise. Forget the actual, nominal value, because that's really what matters. And I think it's going to have an impact.
Yeah, Jeremy, great commentary. Just love having your wisdom here. You have phenomenal ideas. I share many of these ideas, and I appreciate the wisdom. Yeah, these small, on absolute basis, small increases actually very large on relative basis, and that's the affordability. The mortgage payment, 0.5% increase in the mortgage rates, well, based on where the rates are today, could cut affordability by 20%, by the 25%. It's a massive impact on the payments. So it does hurt the affordability. But the one point you mentioned, which kind of is a little surprising to me, and I've heard different data, and I don't have all the data. I wish I had all. What data are you going to trust? I'm going to take a step back, like you said. Yeah. The reported inflation is heavily manipulated. And just like you, I'm convinced we are in most certainly double-digit inflation. I didn't have 15% figure, but it's probably somewhere in the double digits at the very, very minimum. But let me go back to the point of wage inflation. So if you follow the Phillips curve, obviously the unemployment is very low. It's dangerously low. As a result, the inflation is high. That's what the Phillips curve tells us. During the periods of very low unemployment, you're going to have high inflation, and that's happened. But normally the other side effect is the wages are going up for the reasons that it's just competitive. Corporations need to hire, and there's shortage of labor, a lot of open positions, and they wind up paying more. This is happening. I hear it anecdotally, and I don't have the aggregate data. So my expectation is that with this tight labor market, the wages have to go up. And then that will counterbalance to a degree the higher cost of interest, debt payments on mortgages and other things that are linked to the higher interest rates. So what do you think about why you're seeing wages are not yet keeping up with inflation? Again, I don't expect the wages to be in the 15% range, but I expect them to be still substantially higher, not your normal 2-3%, maybe 7, 8, 9%. That would be sort of what I would love to see.
Yeah, good question. So I have a couple of thoughts on this. First is we're going to have to see where wages go, because really now that the inflation is really kicking this year, consumers are seeing the gas price go up. I think they're going to start demanding more, because now it's really starting to very visibly impact them. It's very obvious. It's in the media, et cetera. So I think we'll need to wait 6 to 12 months to see really what happens with negotiations with employees. I think one very important data point that a lot of people don't realize is, the labor force participation is still lower. It's pre-pandemic. It's a couple of points lower than pre-pandemic. It's causing a problem, right? Because there aren't enough people to hire. But what's so fascinating is that there were 9 million small businesses created in 2020 and 2021, partially because of stay-at-home pandemic, partially because there was a lot of stimulus money given to people. They can actually choose to start a business, but they may have not otherwise had, right? And what I think is going to happen, which I haven't seen discussed anywhere, but just mathematically, if somebody started a business 2 years ago and they had limited funds, and they obviously have a limited amount of runway to actually make it work, and most businesses fail within the first 2 to 5 years, right? 90% I think fail in the first 5 years. I think in the next year or two, we're going to see a lot of those people have to go back to jobs. I mean, it's just numbers, it's just data. You know, I don't know this for fact, but it's just extrapolating. So I do think that we're going to start to see more people returning to the workforce. You know, as time goes on, it's going to increase, because that's part of the problem here, and the gap with not being able to hire enough people. A lot of people don't realize that's happened. I also want to point out that, you know, the wage. So part of the challenge with increasing wages, that it causes, like, the death spiral is not a good way to look at it, but it causes a huge inflationary spiral. So what happens is that if you have to increase wages by 10%, call it, okay, then you have to pass that along to customers, or you end up with a much lower profit margin, right? And in some cases, you cannot. So then you lead to price increases. But then the price increases, those employees can no longer afford what they could afford when they got their original increase, and now they're asking for higher wages again. And it's literally a spiral. That's the big thing that the Fed wants to avoid, because if we get to that, that is a huge problem, right? And so I think that part of that will be helped by additional participants coming back into the labor force, but that could take another year or two. So in the meantime, that's why I think it's so critical for the Fed to raise rates, because I think by the Fed raising rates, they're going to put a brakes on the economy. The employers will have to slow down, not hire as many people, maybe even lay off people. And as a result, there'll be more people in the workforce to then get those other jobs, right? And so you have to think of it like that too. Increasing wages. I'm not saying that people don't deserve to earn more, but I'm just saying, and it's a fact, that that's the one thing that wants to be avoided, like the Fed wants to avoid in this particular circumstances, getting to the point where you're like beyond the tipping point of that spiral that we're talking about. So it's something for everyone to keep in mind as they're watching the news going forward.
Well, in some ways, this wage inflation between sort of the tug of war between the prices going up and then the wage inflation, incomes going up, is not necessarily all that bad. In some ways, it's actually a positive thing. Turning that into hyperinflation is the risk. But the wages have been stagnant for too long. And as you said, this commodity-driven inflation, energy-driven inflation, is a major tax. People have to drive, people have to eat. So it's hitting the poor. It's hitting those who don't have the disposable income above the necessities. So you're absolutely right that this is absolutely worst for the low income part of the labor force. So, but let's continue just moving along, because it's a great concept. We could chat on this for a long time. So now let's go into the real estate a little bit more. One point that I absolutely appreciated what you said when you talked about the car purchase. You signed up to buy a car for $70,000. By the time it comes off the assembly line, it's now $84,000 in the config that you ordered. The same, by the way, what's really interesting is the same thing is happening on the new house construction. I've spoken with a number of folks who build ground up, and that's exactly the point. People go into the contract, and then their product takes much longer to deliver, but the price goes up, and there is some contract disputes. What the reality is, the contracts that are written, that there is a variability linked to the cost, and all the new contracts are written that way now. The price goes up quite a bit because of the cost-driven inflation, not necessarily whether the person can still afford to buy it or not. It's just the developer can't afford to sell it for less because they spend so much more on the development. So the supply of housing is still very short, and the development of new product is under substantial pressure from the commodity prices being higher and higher and higher, and supply chain being broken. So as much as the interest could go up, there's still substantial disbalance in the equilibrium of supply and demand in housing. So we're just talking about residential. The other really interesting thing that happens that, just again, would love to hear your thoughts. As affordability worsens, again, let's just say interest rates go up, the wages don't keep up, the affordability drops. What do people have? What options do they have? Typically, they can scale down. So if they were planning to buy $500,000 house. Now they have to buy $450,000 house. So they scale down to a small house.
Yeah.
Or at the lower part of the spectrum, there's always the option of substitution effect and go rent something nice, but just don't pay the mortgage. So what are your thoughts on the substitution effect? If the rates go up, typically fewer people can afford to buy, they're forced to rent. And that sort of puts a little bit more pressure on rental product.
Yes. The interesting thing, look, we have a big housing just unit supply problem in the US. We've had it for a long time. It's gotten worse. And the irony is that if the developer wants to go in and build either a brand new apartment building or brand new house, the costs are so high that they typically have to position it as a Class A or nicer house, right? Or Class A apartment building, because that's the only way to profitability at the moment. The irony is that's not what we need in supply, right? We need Class B and C workforce housing, right? And so you have to wonder whether there might not be better ways to try to increase the supply of housing in cheaper ways. Like, for example, you can incentivize someone to go in and take what maybe was a dilapidated house that maybe wasn't really, nobody was living in it, it wasn't really inhabitable at this point, and rehab it. But because their cost basis is so much lower than replacement costs, now you're putting a more affordable unit on the market, right? That's a side discussion for another time, but it's, it's just so unfortunate that when somebody builds housing to increase supply right now, it's always on the high end because it has to be because of cost, right?
Let me just jump in very, very quickly with one important point. So I absolutely agree with that point. And there's one opportunity that we've seen. We've actually been investing quite a bit in this strategy. It's conversion of an old hotels to workforce housing.
Yes, it's 20 to 30% lower cost, right? It's about 30% lower cost, I think. Yes, and it's a great example, and it's obviously a better use for today, and it ends up being a totally lower cost. And that's a fantastic example of that business model. So thank you. Yes, I'm familiar with that. Anyway, so substitution effect is very real. It's going to happen at the end of a cycle. Whether it was interest rates increasing or housing prices increasing, it's the same effect in the end. The net effect is the same. Affordability peaks at a certain point, and that's typically how a housing cycle ends. We get to a certain affordability level, and you're done. Right? I could tell you in California, for example, if you look at the National Association of Realtors, because that's where I live, once you get to 17% affordability, based on how they calculate it, that's the top. Like that's actually, if you look at analysis of all the past cycles, right, for many decades now. So you could track affordability in your area and sort that out. But the bottom line is, of course, once we run into affordability problems, people either have to downsize, and frankly, they're forced to. The bank will not lend them the money to buy the nicer house anyway, right? So they're going to have to downsize, or they're going to have to rent and hold off their purchase. And I do think that substitution effect is very real. And of course, we saw it actually in 2009, 10, 11, 12. There was a surge in demand for apartments and actually home rentals as well. So very likely that's going to become much more popular in the next few years based on where we are today in the cycle, just how the cycles work.
Great points. You had the number exactly on the point. I was going to say, I knew the number. I was following you. You probably know him, Bruce Norris. He's
yes.
Yeah, and that's the number that he predicted the crisis. Well, I don't know if he predicted it, but he certainly pointed out that around 17% affordability, in California, it causes very substantial problems, and that's probably as low as you go. After that, the prices just can't go up anymore.
Yes, and actually, so the California Association of Realtors publishes that data quarterly, and I'm eagerly awaiting to see what happens, because we just had the interest rate increase, so it's a little bit lagged, or delayed, I should say. But I'm waiting to see what it looks like in Q2 or Q3. I actually look at it every quarter just to understand where we are. And I feel like we're either at 26 or 23. And I'm sorry, because it's like I look at it every quarter, but it's one of those two numbers where we stand today. So we're getting close. How much will 100 basis point that we've already seen increase impact that? I don't know how they calculate it, but I think probably substantially, based on the fact that percentage change is quite high. So we'll have to see.
Yeah, I remember running the math while back, and even a 0.25% increase when you have the rate somewhere in the 3.5-4% basis, it's your payment. I mean, think about this: if you're paying 3.5 and a quarter increase is like 8% increase. So if you have 2 quarter increase, 50 basis points on top of 3.5, that's around 16% affordability change. So what you were paying before versus now, I don't know how that reflects to the actual affordability index,
right?
But it certainly a 0.5% increase in the mortgage rates would increase your payment. And using the DTI formula, debt to income ratio that the banks underwrite, that whole Fannie Mae, Freddie Mac underwriting bucks is certainly written at this point after the 2008 crisis. It's written pretty hard. So the people will just not get those mortgages. They'll have to bring more cash down. By the way, that's been the solution in California. I hear that in the bidding wars and all the competitive environment, the only solution is bring more cash as a down payment, borrow less money if you want to buy that given house, right? Or buy it for cash, or if you have the cash, or if not, just bring a bigger down payment if you can't afford the payment. Your payment is capped simply because of the DTI ratio.
Yeah, and actually there are some like online solutions now, more like, tech companies that provide all cash pre-approved. Like they basically, you say, look, I want to buy this house. They'll give you all the cash up front, and then they'll basically broker a loan for you after. So you can close as a quote unquote all cash, buyer. So you could be competitive in the bid, but then they'll have a contractual obligation with you to then get a loan through you. And I guess there's probably a certain percentage minimum down that they have, and they probably have some type of lien against the home or something in the contract. I don't know how it works, but that's actually providing a lot of these cash buyers with the ability to close, even though they're not real cash buyers too.
Yeah, I've heard of this concept. It's funny. One of actually my good friends, he's a member of the Collective Genius Mastermind. He came up with the same idea, or maybe he was trying to run the same idea, but being a small player versus this 40,000-pound gorillas. Yes. And the idea is certainly very cute to give you a competitive edge while you are bidding on the property. The problem is after the closing, what if
oh yeah,
the borrower can't get the mortgage they need? What happens then? I don't even know what happens then.
Yeah, what happens then is, you see the Zillow effect where they overpay because now they're buying something full retail. They have to resell it probably to a similar price. They're going to have to take all the closing cost hit, and it's going to be a loss, right? So, and that's inherently why, like, I do hard money lending is one of the many things I do, and that's inherently why you don't loan at 100% loan to value, right? That's the whole concept. That's for that reason.
That's right. And when you hear these fintech, VC-backed iBuyers or other technology companies stepping into any market, they just want the market share. They don't care if they lose money. They call it investment, or they call it technology testing. They're spending billions of dollars testing the technology, and it's inherently dangerous because it's not necessarily prudent, or decisions are being made purely from the fact that a lot of money is just chasing these companies, and they need to prove that they have market share. And I don't want to deviate, but there's certainly a number of players today, even in the hard money space, that have been operating at substantial loss trying to capture market share just because they're fintech companies.
I will say though that sentiment in tech world has changed very much so in the past few months since the beginning of the year, from what I understand. There's been a huge shift from growth to profitability mindset. They're no longer funding growth as a number one focus in a lot of cases. A lot of the big VCs valuations have already adjusted, and a lot of people, if you're just a pure real estate investor, you may not realize the Nasdaq's already down more than 20%. Right, from its high. So there's been a lot of change on the tech side. A lot of tech investors or tech employees are now actually more fearful, and because valuations have changed, they're not actually deploying as much capital as individual accredited investors into real estate deals. They've pulled back now, from what I've heard from some sponsors. So that domino has already fallen, and I don't know how many more dominoes will fall as a result of it in that line, but I think that we're going to see a big change in the amount of capital available for the model I described before, where you get the all cash close and other things as well. That's going to change a lot in the next year.
It's actually a good thing. As much as we're used to very low interest rate, everything is growing. The world just doesn't move in a straight line. It needs these spirals. It needs some level of correction so that the market participants can adjust, and folks who came in at the wrong time or were paid, they take a loss, and folks who come in opportunistically when the market cycles, they get a better buy. But I do want to go back to very quickly, and we don't have much more time, but wanted to kind of just hear your thoughts on other parts of real estate markets. So obviously housing, affordable housing in massive demand. So I think that product, by the way, the housing, the multifamily that specializes in workforce, affordable housing, in my view, and this is what I've heard, even though the rates are projected to go up, it's very possible that the prices for some of these assets will continue to strengthen or at least stay where they are because of a disbalance of a supply chain, so a disbalance of the supply and demand equilibrium. So the cap rates theoretically supposed to expand with high interest rates, but when demand is high, and those assets should be able to pass rent increases with inflation, given the substitution effect. Those type of assets are expected to do fairly well. At least that's what I heard. What are your thoughts?
Yeah, look, it's funny. I've invested in many low-income housing tax credit and tax-abated income-restricted apartment buildings in the last 12 to 24 months. I don't know the exact number, but at least 7 or 8. And in fact, I'm investing in one right now, a 2-property portfolio in Houston. And I agree to an extent. Those types of buildings are meant to be defensive plays because inevitably what happens is that if you have a recession and a downturn and there's some downward pressure on rents, your building's already so much more below rent for the average rent. I'm talking about below market rent for the average rent, that you don't have to necessarily be as exposed to reducing rents because you're already the cheapest player in town, right? And to your point, people are looking for more affordable housing. That's where the demand's going. So what typically happens is that you are right, the price doesn't adjust as much. Now on the downside though, is that the local housing authorities dictate the maximum rent increases you can do. Right. And what's interesting about a lot of these cases is that they're actually lagged. So often they publish them 2 years out based on the last 2 years of inflation calculations. So they don't give you a number for 2022 that applies to the current inflation scenario. You'll be able to catch up to that 2023 or 2024, depending on which housing authority you're dealing with. So there's a lagging effect that can be a challenge for investors, but it's definitely a defensive play to invest in those types of properties right now, for sure.
Yeah, I appreciate that wisdom. Quickly, other asset classes in real estate. I don't know to what degree you invest in, but what do you think about storage, industrial, anything else that kind of comes to mind? What do you think about office? People coming back? I've heard the office demand is strengthening because people are going back. Although not everyone, some companies have adopted work from home to a greater extent, but at the same time, I hear some offices coming back.
Yeah, so I'll go quickly through all that. I invest in all those. So self-storage, cool thing about self-storage is that because technically rents are paid monthly in most cases, they have the ability to keep up with inflation, probably one of the best asset classes to do so because they have the ability to increase more quickly than, let's say a 1-year apartment lease, for example, or even a 5-year office lease or a 5-year retail lease. So that's an interesting one to look at for sure. Also with people potentially having to downsize, because of cost of living, they may have to then increase their use of storage to store some of their stuff while they're hoping to transition for a couple of years into maybe finding a different home like we talked about because of the substitution effect. And one more thing I really like about storage, and by the way, I'm not representing the storage association or anything, but I just, these are all facts and what happens numerically is that they have the ability to increase rents on a percentage basis much more easily than a lot of other asset classes because, when you're charging $200 and you're increasing $20 a month, that's a 10% increase, but it's $20. And in most cases, consumers don't want the hassle of having to come hire a moving truck or hire a truck themselves, move everything. They'd rather just pay the $20 to avoid the hassle. So it has probably better ability to increase rents, keep up with inflation, a lot of other asset classes in general. Industrial is going to be interesting because industrial, depending on where you're located, often in industrial properties like this vanilla shell, okay, and there aren't a ton of tenant improvements. There are some exceptions for sure, depending on the usage of it, but you're talking about just a big warehouse building, right? And a lot of them are in more tertiary and secondary markets just based off of where it's most economically sensible. Now, on one hand, in a normal downturn, there's a lot of variability in rent prices because it's vanilla share. You're competing against the next warehouse, and you're not really having much of a competitive advantage, right? You're not in an amazing location necessarily. You're just another box down the street from the other box that's vacant, right? There's not much difference to the person who's looking to rent it. But with the advent of the internet and with internet sales continuing to increase and online sales continuing to increase, it is possible that industrial could fare better than a lot of other asset classes during a downturn, just because of the fact that there's continued demand to have more and more warehouses to be able to meet business models that are online. So we'll have to see what happens with that. But I would caution people that Historically, though, industrial really varies a lot in rents when there's a downturn because it's just a vanilla shell that is just more of a commodity. And then with what was that third one you mentioned? Sorry.
Office and shopping plazas, just a couple of
okay. So office, here's what's interesting about office. On one hand, I absolutely agree. People are going back to work. And I think we're going to see a big difference in working from home in the next year or two. I think that offices are going to demand more and more people come back. They're going to have more leverage, especially if we have a downturn and people are looking more actively for jobs. At the same time, I think what everybody has to watch out for is that a lot of these office leases are 3, 5, 7, 10-year leases. So if you have an office that used to have 100 employees there in a day, but now it's got 50 or 75, and you're locked into a lease from 2018 that expires in 2023, right? In 2023, you're going to look to cut the space you use. You may not move it from that building, but you may not need 100% of the square footage you had before. And I think that's going to lead to a lot of downsizing in office demand to right size for the work from home. And if that happens, then even though there's strong demand right now, people coming back, I think that office is at risk of vacancy challenges or increased vacancy anyway across a lot of properties probably for the next 5 years, right? Just realistically. So that's something to watch out for. Retail is the exact same. A lot of retail leases, maybe 3, 5, 7, 10 years, depending, some are even longer for anchors. But again, retail's obviously had some carnage already, but the bottom line is that, if a center had a lot of 5-year leases that were signed in 2017, 18, 19, you haven't seen the full effect of those rolling over yet, and you potentially will. And just like with office, the retail footprints have come down over time because of the internet. And so that's something to watch out for. Very important when you're looking at a retail deal, you've got to look at the tenant makeup and try to determine, is that tenant still going to need the amount of space it has? Even grocery stores are downsizing. And so it's something to watch out for. Then again, a McDonald's may or may not downsize, right? So just something to watch out for on a case-by-case basis, but definitely a risk.
Yeah, great commentary. I appreciate that. And these the McDonald's and then these out parcels, they're the hottest commodity out there. The Starbucks or whatever that single tenant space. That's the that appears to be at least one of the best parts of real estate on these shopping plazas. So
yeah, look, public companies that are properly rated by ratings agencies like McDonald's, Starbucks, they're always going to have a lot of demand. If they're doing well, those are very long-term leases, triple net leases, and almost like bonds, so to speak. Clearly, they're not without risk, but I agree that those are a little subsection of that could be interesting.
Jeremy, this was awesome. Got to come back. We have actually a lot more things to discuss, but we're running out of time. Don't want to make the episode too long. So appreciate you coming on this podcast. Please schedule back to come back in a few weeks. Let's do another episode. The wisdom you have is just so rich, and appreciate your view. And it's we'll see what happens. The world is the world events are developing rapidly. Hopefully, we'll be in a better position with the war in Ukraine then. But the next conversation, we might see some updates from Fed, and something else might come up fairly quickly. So thank you again. If folks wanted to reach out to you again, I don't know, you don't have to share, but if you want folks to reach out and they want to engage you as a consultant or have you come as a guest on whatever they're doing, what's the best way to reach out?
Yes, absolutely. So just to clarify, I cannot be engaged as a consultant just because I'm so busy. I just did not have time. So just FYI, but anyone's welcome to reach out to me. My email is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll@rollinvestments.com. And thanks again for having me on. I appreciate it.
Thank you, Jeremy, very much.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.